Good morning, this is Larry Edelson for my Uncommon Wisdom weekly market video update for Thursday, June 16th. We're starting to see a lot of the action that I warned you about in the last couple of videos, so let's go right to my charts. We'll start first with gold. As you can see here in the gold chart, we did break this uptrend line that I referenced for you in my video update last week. That is a short-term bearish sign, and I expect the action in gold to synchronize now with the cycles, which are in the short term pointing lower into the early part, perhaps at the latest mid-July. And I fully expect at that point we'll see a actually a third test of the 1477 level. If that gives way, we will probably see gold fall to about 1425. However, when it bases down there, it will be one heck of a buy because the short-term cycles in mid-July will start turning back up, and we will, at the end of August, start entering into the seasonally strong period for gold, which are basically the fall months. So as long as we can hold major support going into this next short-term cycle low in gold, it will be one heck of a buy, because quite frankly we could see record new highs in gold very, very easily before the end of the year, at least at 1800, possibly even up to the $2100 level. Little too early to say, but I do want you to keep your eyes on the short term in gold, because a wonderful buying opportunity will be coming up both for the short term and the long term. We don't want to short gold here. It's too strong. The short term cycles are down, but intermediate and long term cycles are much, much higher over the next few years. So having said that, let's now move on to silver. Silver's a bit of a different story. Long term, the cycles and the technicals, as well as the fundamentals, are as I've been telling you in the past few weeks, now confirmed for a substantial move higher in silver. But short term, silver remains extremely volatile and at high risk of another major leg down as we go into mid-July. Specifically, I want you to take a look at these two dashed lines I have for you on this chart. Let me pull this chart up for you a little bit more. I'm going to click on each one, this one here and this one here. As you can see, they converge into early July at around the $28 level. That area is going to act as a magnet for silver. The short-term cycles are pointing lower. We need one more leg down in silver. I expect it to unfold with some weakness in gold, but silver, unlike gold, will fall much, much greater in both velocity and in terms of depth. And quite frankly, if we can get down to this $28 level, it will be one heck of a buy for the longer term. There is still the risk that silver could penetrate this area and fall to 23, but the more time it takes to get down to this level, the better the longer term prospects for silver. So if we can meander lower for the next week or so and then take a sharp leg down into early mid-July down to the $28 level, that would be very, very bullish long term for silver. I want to go now to the dollar index. The dollar index is pretty much doing exactly what I expected it to. It's betwixt in between. The euro has rallied against the dollar, the Swiss franc has rallied against the dollar, and then the dollar has rallied against the euro and the pound. And we have a mixed bag in the currency markets, and that's simply because on a fundamental basis the world is dealing with a sovereign debt crisis in Europe and the United States. And as long as that continues to unfold, we're likely to see net sideways movement in the dollar index to lower in the context of long-term bearish trends for the dollar overall. And we're likely to see back and forth between the euro and the dollar. One week the euro gaining against the dollar, next week the euro losing against the dollar, and the dollar gaining against the euro. It's going to trade back and forth on a basket-wide currency basis, given the dollar index in here. Individual currencies, it's a different matter. I would buy Swiss francs on dips. I would buy the Aussie on dips and breakouts, and Canadian dollar, natural resource type currencies, and Asian currencies especially some of the stronger Asian currencies like the Thai baht and, of course, the Chinese yuan, where I've recommended a position for my readers. Now, let's go to the Dow Industrials. Here, too, we're seeing some volatile action with an overall net short-term bearish bias. Not surprising to me. I believe we're in store for a test of the 11.6 level in the Dow, and then we'll have to see if the long-term bullish cycles can kick in and lift that market back up. Remember, as bearish as the economy is, the thing that's going on with stocks right now is that they are in the process of being monetized by the weakness in the US dollar. And although we've seen no real signs of Mr. Bernanke ready to come out with QE3, I have no doubt as the fundamentals of the economy continue to roll over that Bernanke is going to come back out there with QE3, more money printing, and that's going to have the effect over the longer term of monetizing the broad stock markets, especially blue chip stocks in the Dow Industrials, the S&P 500, higher, just like it's doing for commodity assets. Now, this is a whole philosophical argument. A lot of people are against what Bernanke is doing. I am basically too, but right now it's the only thing he can do is really print money. He cannot print jobs. We all know that. And he doesn't expect to be printing jobs. He does go to bed hoping and praying every night that his money printing and reflation attempts will eventually cause enough of a wealth effect to spur new entrepreneurism, new technologies, and boost the economy over the longer term. Now, will it work? Nobody knows for sure. There's lots of historical evidence that it won't work. I'm kind of neutral on it. I believe on the one hand, in the short and intermediate term, it's not going to work. Longer term, it has a chance to work, but not, of course, not without dealing with our debts and dealing with our monetary system, which is broken, the dollar reserve system, which is broken, tax policies, fiscal spending. All those things need to be fixed, repaired, replaced, or none of this is going to ever work. So keep that in mind. We are in really a new world, and we're dealing with a monetary system that's broken, a debt mountain that's crushing Europe and the United States, and the rise of emerging markets, which is where 84% of the world's population lives, nearly 6 billion people. This is really a new world, and it is very interesting times indeed. So stay tuned to everything I publish, and I'll be in touch with you again next week. Have a good weekend.